What's going on? Alex here, and today I'm answering your tax questions from Reddit. And today's question has to do with the deduction of business losses and or startup costs from other income such as wages. Let's take a look. All right, this question comes from Hey Manu and goes as follows. Can you deduct business losses / startup costs from regular salary? This is in Washington State, a state with no income tax. I work a 9 to 5 and have a W-2, but I want to start building social media following / business. I plan to invest heavily in growing my Instagram, YouTube in 2022 with paid collabs, promoted posts, recording equipment. So my influencer business would be running at a loss for the first year, at a big loss, no less. Question is, can these losses offset my salary? All right, so there are a few considerations here to take into account. First one has to do with whether this activity rises to the level of a trade or business, because believe it or not, for income tax purposes, that is something to be achieved for the potential benefits that go along with having a trade or business from an income tax perspective. And there are essentially 9 factors that the IRS considers, and neither of them are all-encompassing. So you can have just a few factors working in your favor, but the more of them that apply to your particular business, the better it looks to treat that business as a trade or business for tax purposes. So let's take a look at what those factors are. Now, there's an IRS webpage here that is called Earning Side Income. Is it a hobby or a business? If it's a business for income tax purposes, it's a bona fide trade or business, and you're deducting ordinary and necessary business expenses, then you may very likely be able to offset the salary with the losses from the business. But if your activity does not rise to the level of a trade or business, then it may be classified as a hobby for income tax purposes, in which case the deductions are going to be limited to the income. All right, so in that case, if it's a hobby, you are not able to offset salary with any losses from that hobby. So this list is very important to consider prior to taking any of these sorts of deductions. And it says here are 9 things taxpayers must consider when determining if an activity is a hobby or a business. Let's take a look. Whether the activity is carried out in a business-like manner and the taxpayer maintains complete and accurate books and records. So this is where accounting is important. Sometimes clients go, I don't want to worry about the accounting. But at the end of the day, if you have a business, it's traditional or expected, I should say, to have books and records available. So that's accounting, basically an income statement, balance sheet, that pretty much gets you there. Next, whether the time and effort the taxpayer puts into the activity show they intend to make it profitable. So that's an important point as well. So if you like to knit and every once in a while you knit a sock and a hat, that may not rise to the level of a trade or business, all right? It needs to have some consistency there and to show that you're making an active effort to make it profitable and to grow it, to get new clients, to market it, advertise it, all that good stuff. Third, whether they depend on income from the activity for their livelihood. So that's also a good indication that it's a business, because if you're a plumber and you happen to have a plumbing company and you're relying on that income to live, it may very well be classified as a trade or business. It's hard to make the case that a plumber with a plumbing company is doing it as a hobby. I guess you can make that argument, but I think it's an uphill battle. Whether any losses are due to circumstances beyond the taxpayer's control or are they normal for the startup phase of their type of business. All right, so that's another factor to keep in mind. Whether they change methods of operation to improve profitability. So if a business starts out with having consistent losses, is anything being done to mitigate those losses? Are they decreasing over time? And let me be very clear. Businesses can have losses year over year and not be classified as a hobby, but what you get into is that if a business has losses in at least 3 out of the last 5 years, then there's what's known as a rebuttable presumption that that business is a hobby. So the IRS could say, look, in 3 out of the last 5 years, you had losses. So we're going to assume that this is a hobby. But you can rebut that presumption by addressing these factors and saying, look, my activity meets a lot of these factors that are described here. So it is a trade or business. Let's remember, Chrysler has been losing money for years, and nobody's going to classify them as a hobby, okay? So rebuttable presumption, 3 out of the last 5 years. If you have losses, now you're getting into that aspect or that test of whether that activity rises to the level of trade or business, that's where these factors come in, just to add a little context. Let's continue. Whether the taxpayer and their advisors have the knowledge needed to carry out the activity as a successful business. All right, so that's interesting, maybe a little bit of subjectivity there, but if you're just trying to start the next SpaceX and you've never taken a physics course, that may very well work against you in deducting some of those losses, all right, just as an example. Next, whether the taxpayer was successful in making a profit in similar activities in the past. That's another factor that plays into it. Whether the activity makes a profit in some years and how much profit it makes. All right, so if you have kind of ups and downs, generally that's fine, as long as you can satisfy as many of these factors as possible. Again, neither of these factors is determinative. So if you satisfy some of them in one year, some of them the next year, you may be all good. But just keep in mind that this is what's on the radar in terms of questioning whether an activity is a hobby or a business for income tax purposes. And whether the taxpayers can expect to make a profit, future profit, from the appreciation of the assets used in the activity. All right. So those are the factors here. Notice what's missing. Putting together a business entity is not on this list. You're not going to fool anybody from an income tax perspective just by doing your hobby under an LLC or doing it under a corporation. You're not fooling anyone, okay? So unfortunately, that's not a way to get around it, and that's why you're not seeing it here. It's not one of the factors, okay? And similarly, the fact that you engage in a hobby consistently throughout the year still doesn't make it a trade or business, right? So you may like fixing bicycles, and if you fix bicycles for friends and your uncle and the neighbor and everybody that's in 5-mile radius of your house, and you never charge them for it, but then you decide to charge one person, your activity may not rise to the level of trade or business just because you're not really meeting all of these 9 factors necessarily in that case. You may, but I feel like it might be an uphill battle. So with that, the first question you're going to have to deal with in this scenario is whether this activity, and I always take a step back when I see the word business in quotes, all right? We're already off to a bad start, but you have to really assess whether your activity will rise to the level of a trade or business for income tax purposes. And from there, you'll be able to determine if you can write off those losses or if the losses are going to be limited to the income, as is the case with a hobby for income tax purposes. All right. And again, I'm not saying that an activity is a business or a hobby from a judgmental perspective. I mean, if you like to weave baskets underwater, that could be a hobby or a business, depending on those 9 factors. So again, it's not that I'm making a judgment that a social media influencer is a business or not a business. That's completely not the case. What I'm saying is these are the factors to keep in mind once you're making that assessment. Fair enough? Okay. So the other aspect is the timing of the expenses. And what I'm seeing here is that there are the potential for startup costs. Now, what are startup costs? The tax code has a provision. It's called Section 195. Here it is in all of its glory. And it has to do with startup expenses. And startup expenses are those expenses that you pay before your business becomes an active trade or business. And you might say, Alex, how do we determine when the business became an active trade or business? That's a great question. And while it may not seem like it, sometimes it's harder to answer that in a number of cases, because you may start some of the activities of the business in January 1st. You may have gotten a website in March 1st. You may have done some marketing in April 1st. And the question is, has the business started? All right. So you have to look at the facts and circumstances to determine that business start date. And sometimes you could do some planning up front, in that if you do plan to make startup expenditures, you want to make sure the business is active as of a certain date and then incur the expenses moving forward. Here's why. Startup expenditures basically allow you to deduct basically $5,000 of startup expenses in the year in which you begin the active trade or business. Okay. And that $5,000 is reduced by any amount that the startup expenses exceed $50,000. So if your startup expenses are $60,000, you can forget about all this. But the important thing is that the $5,000 is going to be deductible in that first year. The rest is going to be amortized or deducted over time over a period of 180 months or 15 years. Okay, so it's going to be a little while. And that's why if you can avoid the startup expense treatment, it's generally preferential, because then if you incur the expenses after the active trader business has begun, then you generally would be able to deduct Section 179, bonus depreciation, all these other accelerated depreciation provisions. They kick in for expenses that you incur after the business has become an active trader business, not before. So if it's before it's an active trader business, then you may have to deal with these startup expenditure limitations. Okay, so if you have 60,000 startup expenses, you may very well not be able to deduct any of them in the current year in which the business becomes active. But if the business becomes active on July 1st and you pay those expenses after July 1st prior to December 31st, then we're talking about possible bonus depreciation, Section 179, all those other accelerated depreciation deductions. So that start date of the business for tax purposes is extremely important. And just because you got a website on January 1st, just because you bought an ad banner on January 1st or got a name tag on January 1st, that doesn't necessarily mean your business became active. So sometimes we actually do an analysis of, hey, let's take a look at what it takes for your business to be considered an active trader business. And from then on, you want to incur all of those expenses so we can accelerate the depreciation deductions. Hopefully that makes sense. So that's the other question is, in terms of timing, are you incurring your expenses before it's an active trader business or after it's an active trader business, assuming it rises to the level of a trader business based on what we discussed earlier? These are the two hurdles. Once you pass these hurdles, then you may very well end up with a deduction that offsets your ordinary income. Let's take a look at what that might play out as on the tax return. So in this tax return, I have a very basic Form 1040 for 2020. The 2021 software hasn't been finalized yet, so we're going to look at that prior year. And in this example, I have $100,000 in wages. So this is W-2 income, fairly straightforward. And you can see here there are no other deductions aside from the standard deduction. All right. Now, if we go to the Schedule C area, which is where an individual who's a sole proprietor or freelancer would report their income and expenses, let's say that there is no income and the expenses are $50,000. So if we go back to the 1040, now we see that there's $100,000 in wages and there's a $50,000 loss from Schedule 1. We see that on Schedule 1, that loss comes from Schedule C, and Schedule C is where freelancers and sole proprietors report their income and losses. So assuming you meet the criteria to have this activity classified as a trader business for income tax purposes, if it rises to that level, and second, assuming you're incurring these expenses after the activity has become an active trader business, so those two hurdles right there, then we can generate a loss in Schedule C if the expenses are ordinary and necessary business expenses. All right. So there are caveats. This can be a complicated area. Don't just write off $50,000 based on what you heard here. Okay. You need to talk to a qualified tax professional to determine actually what's deductible and if it's reasonable given the circumstances. But once you've done all that, going back to the 1040, we see that it's $100,000 minus the $50,000. That gets us to $50,000 adjusted gross income. And once you take out the standard deduction, you have the taxable income of $37,600. Whereas before, if we don't have these losses, let's take a look at what that amount is in terms of the taxable income, $87,600. So assuming a few things. One, your activity rises to the level of trader business. Two, the expenses were paid after the activity became an active trader business, not before. And three, assuming they're ordinary necessary business expenses, then there's a very good chance that you may be able to offset your other income, meaning wages, interest, dividends, all that good stuff, that the tax implications related to those elements with these losses. Okay, so a few considerations to take into account. Don't just throw all of your quote unquote business deductions on Schedule C and start writing it off against ordinary income. This is a very commonly audited area. If you have Schedule C with huge amounts of losses, especially if it's for multiple years, you have to watch out with that. because it's very easy for the IRS to pick that apart. They don't have to do a lot of work. And you don't want to make their job easy. You want to file nice, boring tax returns that don't attract any attention whatsoever, so you can sleep at night and your tax preparer can also sleep at night. So, Hi Manu, hopefully this answers your questions with regard to how to handle all this good stuff. Now, again, you want to assess if this rises to the level of trade or business. You also want to figure out what those total losses might look like, because this activity might be better handled in a separate business entity. So if we take it off of the Schedule C completely and put it into, let's say, a S corporation or something along those lines, or if it's a partnership, if there's somebody else involved, that may also help to separate the personal return from the business. That tends to make things a little bit clearer. So in some cases, if we have really massive losses, we'll put that in an S corp. There's a whole bunch of considerations that go along with that, but it's good to separate out the personal and the business just to keep things a little bit more clean. In some situations, we do an assessment based on the individual circumstances, but it can help in some instances. All right, so hopefully that helps. If you found this video helpful, like the video, subscribe to the channel, leave a comment down below. If you leave an interesting comment, I might answer it in a video just like this. With that said, thank you for watching, and hopefully this was helpful.